We got a new jobs report last week that came in way too strong, and as a result, mortgage rates are suddenly back over 6.5%. On Friday, after this report came out, rates jumped nearly 0.3% in a single day. And if you've been watching these weekly updates, then you know I've been saying the Fed cares way more about the labor market than they do about inflation, even though the number they usually talk about is inflation. In fact, if the labor market doesn't get significantly weaker, I think it's very likely we've probably already seen the bottom for mortgage rates this year. And for everyone who thought the Fed cutting rates 0.5% meant that mortgage rates were going to come down again, they're actually up 0.35% since they've been announced. We also saw another increase in the number of people applying for mortgages last week, but I doubt that's going to continue this week as mortgage rates jumped that much. Housing inventory is still continuing to grow, but it's getting slower every week now. New listings remain above where they were in 2022 and 23, but they look now just to be trending down for the rest of the year like normal. So we're covering all of this and much more in this week's market update. My name is Michael. I'm a real estate agent here in the Dallas area, and every Monday I give you a weekly update covering all of Dallas and Collin counties as well as the national market. We're looking for trends, we're tracking mortgage rates as well as mortgage purchase applications, as that's our best leading indicator to what demand will look like 30 to 90 days from now. We're looking at things like median list price, days on market, how many homes are having price decreases, what's inventory looking like, and if you stick around until the end, it's my favorite part, the top 10 ranked hottest and coolest cities and zip codes in all of Dallas and Collin counties. If this sounds like something you're into, make sure and hit the subscribe button. And if you're looking to buy or sell in the Dallas market, whether it's next week or next year, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that info is in the description below. Okay, today is October 7th. Let's see what the data is telling us. And if this is an old market update, you can click the playlist here to get to the latest weekly market update. Okay, first up is market news. We're talking about this jobs report. So in this jobs report, total employment increased by 254,000 jobs in September. So that's one sign that the economy is still strong. On the other side, employment barely changed, is still about 4.1%. So this headline number beat estimates, but even worse than that, or better depending on which side of this you're on, is that we actually had positive revisions for the last 2 months of 72,000 jobs. That means the last two reports that came out, they actually reported short 72,000 jobs. So we had 72,000 more jobs than we thought when we were cutting rates. And it's actually pretty unusual to be revising the numbers up. Over the last several reports, we've actually had to go back and revise them down. So we added 254,000 jobs, plus we added 72,000 jobs from the last two reports, plus unemployment barely changed, plus wage growth is up 4% year over year and 0.4% for the month. Another big thing we're always tracking as far as unemployment is the jobless claims. And this is a number that comes out every Thursday, so it's a great leading indicator to what's going to be coming. So this chart is the 4-week moving average of the initial jobless claims. And if you think there's a job loss recession coming, this number would have to be well over 300,000, probably over 320,000 on the 4-week moving average. That's when we're in job loss recession territory. Instead, you can see we're continuing our journey down. We've been in a clear downtrend since the beginning of August, less and less initial jobless claims. So this is the opposite of what you want to see if you want mortgage rates to come down. If you want mortgage rates to come down, you need the labor market to look weaker. You need these initial jobless claims and then ultimately unemployment to be going up. And as of now, we're all the way down to 224,250 jobless claims on the 4-week average, so nowhere near concerns of a job loss recession. And then another big indicator we've talked about before that a job loss recession is coming is that it usually starts with residential construction workers getting laid off. So home builders laying off construction workers is usually the first domino to fall in a job loss recession. So that's something we'll always be looking for. So where are we at with that? Well, in this report, construction labor grew again by 25,000 jobs. So it's obvious that home builders were taking advantage of these low rates, and you can also see that in the number of single-family housing permits are starting to climb again, whereas they had been on the decline. So rates coming down means they're building more houses, they're hiring more construction workers, which is the opposite of a job loss recession. Now the question is, are they going to continue pulling more new single-family permits if rates start climbing back, 6.75, close to 7%? Because that's when they started declining. And what we need to keep in mind about this report is there's probably going to be a revision down. As I've said, that's happened many times before. We happen to have a revision up this time. That's unusual. I think it's more likely in the future this number will get revised down, but as of now, things are looking very strong any way you look at it. So what we're seeing here is that the labor market is softening in a nice, slow, and steady way. Nothing is breaking. Nothing is even close to breaking. This is what the Fed is trying to accomplish. And this is all great news for everyone, except that it means mortgage rates are not going to be coming down more anytime soon. Because remember, the Fed is already reaching their goal in a nice, steady, controlled way. Why in the world would they cut rates and run the risk of the economy overheating? They won't. So this is good news for everyone everywhere except people who are trying to buy a home, because it means you're going to have to buy at a higher mortgage rate. And if you've already purchased, it means you're going to have to delay your refinance until rates actually come down. But overall, this is a good thing for the economy. So in my opinion, the goal for the rest of the year is going to be to keep rates around 6.5%, maybe a little higher, maybe a little lower, because I think the high sixes will slow home builders from continuing to pull more permits, and nobody wants that. And then I think the low sixes, like we saw, we got as low as 6.1, I think staying there for a sustained period of time would run the risk of overheating the economy. So I think we're going to be plus or minus 6.5% for the rest of the year, unless we see some big change in these jobs reports that suggest a job loss recession might be on the way. But things are moving very slow and steady, so I don't think that's going to happen. Okay, moving on, let's start with national housing inventory. This week, we had a small increase of 3,273 more homes for sale in the country. This keeps us at that same 37% more inventory than we had last year. We've been just hanging out about 38% more. But this gets us up to 734,290 homes available for sale in the country. A fun fact is, the same week last year, inventory was only at 537,032 homes. So we've got nearly 200,000 more homes than last year, which is great news. And if you see in 22 and 23, inventory continued to climb until the end of October, early November. So it will be interesting to see if that continues this year. But you have to remember, in both of these years, mortgage rates were climbing, whereas supposedly this year, rates were supposed to be dropping. As I've said, I think that's unlikely. If they drop, it's not going to be very much. So I'm not exactly sure what's going to happen with inventory this year. But just know for the last 2 years, they've continued to climb. In other years, this would be about the point where they start declining. And then for reference, the all-time inventory bottom down here in 2022, we only had 240,000 homes for sale. At the peak of last year, we had 570,000. This same week in 2015, we had about 1.169 million homes for sale. So as you can see, we're way better than the previous 2 years, and we're definitely still heading in the right direction. So maybe sometime next year, we get much closer to a normal market. Now we're looking at new listings. This week, we had 60,655 new listings in the U.S. Mortgage rates coming down led a lot of people to jump to list their homes on this spike, and then on the official announcement that the Fed was cutting 0.5%, we saw another big spike here. These two things led to us having more new listings every week than we did in 22 and 23. As you can see, most of the year, we were well below 2022's numbers. So it's great that we're finally above 2022. And it's obvious that the perception of rates coming down is causing more people to list their homes. But now that rates are going back up, it'll be interesting to see if that stops. But thanks to those weeks of low rates, we're finally doing better than the last 2 years, but we definitely still need more inventory coming onto the market to get back to a normal market. And then the last thing I always say is you need to understand from here until the end of the year, we're going to be seeing less and less new listings coming onto the market every week, which means you'll have less and less new options to choose from every week. So if you're in the market to buy a home right now, this is probably the most options you're going to see. You're going to have less from here on out. Now we're looking at pending sales. You can see the weekly pending contracts data was just barely above 2023 levels for most of the year. Right now, we are so close to crossing 2022 numbers after look how behind we were the whole year. And in fact, we're only 4,000 homes away from being at that 2022 line. And what's normal this time of year is we should be going down. Instead, we're going pretty sideways. That, of course, is due to low rates. But you've also got to remember, while these numbers were going straight down at the end of these 2 years, mortgage rates were going straight up. Whereas right now, we don't actually know what's going to happen with mortgage rates. Presumably, they're not going to be going up from here. They were supposed to actually be going down for the rest of the year, but as I've said, I'm doubtful that's going to happen, so it'll be interesting to see what happens with the pending contracts moving forward. But this week we have 354,816 homes under contract, which is actually about 8.6% more contracts than we had last year, so a lot more contracts right now. Okay, the last thing we cover nationally is the percentage of homes having price decreases. Every year it's normal for a third of homes to take a price cut before selling. Looking at the national chart, we had a small increase this week, up to 39.5% of homes having a price cut. Last year we got as high as 39.2. The year before we got as high as 43.2. And as you can see, the last 2 years, normally we would be going up until about the beginning of November. But instead, we're actually just going completely sideways. Of course, again, that's because rates have been low, more people have been coming in to buy, so there's less needs for price cuts. But now that they've gone up again, over 6.5%, I think it's likely this goes up a little bit, but nowhere near 2022's numbers. And as of this week, we're actually 2.4% lower than we were in 2022. But just know, even if it were to continue up until the beginning of November, that would be totally normal. Okay, moving on to mortgage rates. As you can see from this chart, look how crazy that jump was, 6.26 to 6.53, and it actually looks like we're going to be going even higher today. I'll show you why here in a minute, but yeah, we started last week at a 6.24, we got down to a 6.2, and we ended at a 6.53. That's the biggest move we've had in a while. Now, if you'll see, we're still 1.17% better than we were last year, but man, people were really enjoying these 6.2% rates for the last couple weeks. And I've been saying it for months now, but there's not going to be any real buyer demand. Like, we saw a little bit of buyer demand come in here around 6.2% rates, but the real demand is going to happen once rates get below 6% for a sustained period of time. The evidence I have for that, home builders have been offering that, and they've been selling way more than existing homes. So at the point that we get and stay below 6%, that's when the real home buyer demand comes in. So we're still not there, and we're headed in the wrong direction. But just look, back in May, we were in the mid sevens, 7.5. So we're still a full percent better than that. We're just not where we need to be yet. And this is how I know mortgage rates are going to be even higher today. So this candle was Friday. This is the 10-year. And if you know, mortgage rates track very closely to the 10-year. And so we closed up here at about that 3.97. We opened up higher, and we are still climbing. So if I had to guess, I think we're probably going to come up and try to touch this line before we come back down some, and then we'll just have to figure it out from there. We've got more inflation reports coming up, so I don't actually think it's likely we break above this line. I do think we'll touch it. And this green line is actually a prediction that I made back when I made a video on why the Fed cutting rates doesn't necessarily mean rates come down, but I was predicting here's what I think will happen based on the jobs reports at that time and the inflation reports, was that we would likely see a spike down into this line, which ends up exactly where we touched. I thought we would bounce back up, hold steady around here. That's exactly what happened. And now the jobs reports are coming in too strong. That's why I think we're going to come back up, touch here, see how it resolves from there, probably comes back down to hang around right here, which is about that 6.5% rate. But this is what's so crazy, is you can see how big of an impact just one strong jobs report has. All of this. So if we get one bad jobs report, it'll come down. Sadly, there's no way to predict jobs reports, but at least we can predict in the short term what's likely to happen. But once again, the 10-year is going up. That means mortgage rates will be higher today than they were yesterday. Now we're looking at mortgage purchase applications. So this week we actually saw a 1% increase, which is actually a 9% year-over-year increase in the number of people applying for mortgages. This makes for the 6th straight week of mortgage purchase application growth. And last week was a big milestone because it was the first time since 2022 that we actually had positive mortgage growth. And obviously this week being 9% higher is a big deal. Again, you have to remember mortgage rates were going straight up at the end of the year for both of these 2 years. I don't know how going back up to 6.5% is going to affect mortgage application growth. And I don't personally think that we're going to get over 2022 until we get closer to that below 6% for a sustained period of time that I was talking about. That's when the real demand is going to come in. Okay, before we move on to the local market data, if you're considering buying a home in Texas in the next year, 2 things. Number 1, if you don't want to go broke buying a house, I've made a home finance course for you where we'll go through and discover your actual personal spending habits straight from your bank account and determine the exact amount that you could spend on a housing payment without going broke. Then we explore how much house could that get you today in today's market with today's rates. It takes into account everything down to things like how much should you be saving for a maintenance budget based on the age of the house? How much more or less might your utilities be if it's new construction versus old construction? It takes into account literally everything all the way down to your income tax bracket. This course is a no-brainer for anyone who wants to have full peace of mind about their purchase. Then number 2, if you're still a ways out but you just want to get fully educated and know every single thing there is to the home buying process so that it's nice, easy, and peaceful when you're actually ready to step into the market, I've made 2 courses. One is for pre-owned homes, one is for new construction. They're totally different experiences, different contracts, different deposits, different timelines. So choose the one that best suits you. Links to all of those are down in the description below. Okay, moving on to the local market data. We're starting with the MLS data of Dallas County. In the last week, we had 658 new listings. That's 127 more than last week. That's a ton of new listings. We had 335 closings. That's 44 more than last week. Of the homes that closed, 67 were immediate sales, meaning they contracted within the first week. That's 15 more than last week. 285 went under contract. That's 5 less than last week. In total, there are 2,034 homes either under contract or pending. That's 58 less than last week. So you can see there was a lot more activity this week than usual. Now looking at Collin County, there were 430 new listings. That's 75 more than last week. 292 closings, that's 39 more than last week. 49 were immediate sales, that's 7 more than last week. 183 went under contract, that's the same as last week. In total, there are 1,751 homes either under contract or pending. That's 59 less than last week. Okay, moving on to the Market Action Index, starting with Dallas County. If you're not familiar, it just takes all of this data, puts it into one easy to read graphic with a number. Anything a 30 or below is a buyer's market. Above that, we're asking how much of a seller's market are we in? And what we use this data for is to see, is everything looking normal or is it looking weird? What normally should be happening this time of year? We're in October. The market should just be cooling off all the way through the end of the year and into January, and then we'll start to grow again in February. So that's what we're looking for. Are things cooling off in a slow, steady way? We can see the median list price has not really moved for the last month. The median price of new listings has actually gone up a little bit. That's not usual, but again, rates did drop. Average days on market slowly climbing up just by about 1 every week, which the median days has been at 56 since September 13th. It's not moved. The number of homes having price decreases, it's been pretty steady. I mean, even since August. Just like the national data, we're basically moving sideways on that. The number of homes relisting remains very high at 9%. You can see that the new listings data remains high. A lot of new listings this week. 9% of those had listed before and are now relisting. And this has been high every week. Inventory is continuing to climb by about 50 homes this week. So that's normal. Inventory should be growing. And the Market Action Index is trending down, which is normal. So everything looks normal except the median price of new listings has gone up and the median list price overall has been holding steady, whereas usually those would both be trending, in a slow, steady way down like they were here. But that's because rates came down. That stopped the prices falling. Now that they're above 6.5%, we'll see in the weeks moving forward if those start to drop again. Okay, so Dallas is a 38, slight seller's advantage. Let's move on to Collin County. Collin County, we had this big jump of the median list price. This is why we don't ever worry about 1 week data. You can see a few weeks later, it trended back down. Now it's all the way back almost to where it was before it jumped on August 30th. We're still about $10,000 higher of the median price of new listings, but the overall median list price has been holding steady, just like Dallas, which again, normal would be trending down. Instead, they both have been holding steady for now. Their average days on market went up 1, the same as Dallas. Their median days is a little lower at 56. Their homes having price decreases has actually been declining a little bit, holding steady / declining. Really, I would say this is flat. It literally declined this week, but overall it's basically staying flat. Their number of homes relisted is high as well at 8%. Their inventory is climbing just much slower than Dallas, but it is climbing, which is what it's supposed to do. And the Market Action Index as well is trending down. So they're at a 36, slight seller's advantage. Yeah, everything is pretty much looking normal. Now we're moving on to the pending sales, starting with Dallas County. As you can see, what should be happening this time of year is things should be trending down. Instead, we're remaining flat again. Of course, low rates brought in more buyers. There's more pending than there was last year because the last 2 years we were headed up all the way to 7 or 8% rates. So as of last week, things have not slowed down. Of course, rates just now got over 6.5%, so it will take probably a week or two for that to show up in things like pending data. And then looking at Collin County, the same, not going down, basically going sideways. So those are the only unusual things about the market. Pending sales are going pretty much sideways when they should be going down, and then as well the median list price is kind of going sideways instead of going down. Other than that, everything is normal. And then the good news is we have more pending sales in both counties by a lot, which is what we need to get back to a normal market. We need more sales happening. You've seen on a lot of the charts I've shown, we're still below 2022's numbers on a lot of charts. Well, not in pending. In pending, we're out of both 2022 and 23 here in our local market. Okay, now we're moving on to the hottest and coolest cities and zip codes in all of Dallas and Collin County. These are ranked using that market action index number. Remember, a 30 or below is a buyer's market. So starting with the hottest cities, we had Carrollton, Ferris, and Saxe remained in the top 3 spots. Grand Prairie heats up 4 spots. Irving heats up 1. Lancaster cools off 1. Louisville remains. Garland heats up 1. Duncanville cools off 5. And Plano remains at the number 10 spot. Then zooming into specific zip codes, the absolute hottest is Carrollton 75007, followed by Irving 75061, Allen 75013, Carrollton 75010, Dallas 75244, Dallas 75234, Garland 75041, Garland 75044, Dallas 75236, Plano 75023. So these are all a 43.61 and above. So still pretty hot for this time of the year. Then moving on to the coolest cities, the absolute coolest remain Blue Ridge, Leonard, Sunnyvale, Van Alstyne, and Anna all kept their spots. They are all buyers markets because they're below a 30. Then Prosper cools off 1, Salina cools off 1, Whitewright heats up 2, Rockwall remains at number 9. Lavon jumps onto the list as the hottest city on the coolest cities list, replacing Farmersville, which was the hottest last week. Then looking at the coolest zip codes, all of these except Prosper are actually buyers markets. So the absolute coolest at a 22.66, that's Blue Ridge, Texas, 75424, followed by Dallas 75204, Leonard 75452, Sunnyvale 75182, Dallas 75220, Van Alstyne 75495, Rockwall 75032, Dallas 75219, Anna 75409, and Prosper 75078. As always, if you're looking to buy or sell a home here in the Dallas area, whether it's next week or next year, I'd love to connect. Call, text, or shoot me an email. All that is in the description below. Thank you for watching. I'll see you in the next video.